Hi, thank you for joining us for our live webinar on trading Forex amidst inflation. This is Phil Gunn, your presenter for today. We'll be starting the session proper at about 7:02 p.m. Let's give a couple of more minutes for our friends to join us. Meanwhile, grab a drink and we'll start real soon. Good evening, everyone. Thank you for joining us for our live webinar on trading Forex amidst inflation. This is Phil Gunn. I'm a account manager with Phillip Futures. In today's webinar, we'll be discussing Forex trading on the MT5 platform. Before we begin, I'd like to do a quick sound check. If you can hear me, just type yes into the question box. Also, during the webinar, if you have any questions, do type them into the question box and I'll address them during the Q&A session at the end of the webinar. Okay, it looks like everyone can hear me clearly. So let's begin tonight's webinar. My name is Phil Gunn, the speaker for this webinar, and I've been with Phillip Futures for more than 10 years now, since 2008. I hold a dual license in futures and stocks, and I'm an account manager to help clients trade futures and Forex, as well as shares with understanding of the product and market by providing coaching and economic information to make proper trading decisions. Recently, we have seen news of inflation emerging reflected in the economic CPI numbers. Many central banks are talking of reducing asset purchases in expectation of recovering economy. Typically, US takes the lead in doing so, but due to the Delta COVID variant, many countries are cautious and extending lockdowns, affecting the timeline for economic recovery. We will take a look where we are on the fundamental development of the road of economic recovery with what the Federal Reserve has said about inflation. That'll be left for the last part today. We'll first touch on the understanding the mechanisms of Forex in the first half of the webinar. Throughout the webinar, you may have questions. Feel free to post them in the question box. My facilitator will arrange them and let me know, and I'll answer them during the webinar or at the end at the appropriate time. This webinar itself will also be put on later for you on the YouTube for you to revisit if you want to do so. Okay, let's get right into it. First off, with a disclaimer here. Before we start, this is a disclaimer. Materials provided here is for general information and does not constitute a recommendation or solicitation to trade. The agenda. Before we start trading Forex, you need to understand the characteristics of the contract. For understanding the basics of Forex, how does the whole process work? You'll be analyzing the risk involved and develop a proper trading plan to manage the risk. So that's what we'll do first, to review the characteristics of the Forex contract. Then we'll take a look at what are the common major Forex pairs they are trading. We will then move on to the calculations of the individual trades and what are the costs involved. The second part of the webinar, we'll look at the fundamental development of the inflation story. What is the projected timelines of inflation expectations for various central banks, including the Federal Reserve, European Union, UK, and the RBA from Australia. After that, we will analyze the technical aspect of the charts of these forex pairs, namely euro dollar, pound dollar, Aussie dollar, dollar candy, and dollar yen. Lastly but not least, we'll do a quick MT5 demonstration if we have time. Okay, let's start off with how does forex work? It is a huge market. The average traded volume is around US 2 billion daily. Forex is traded over the counter. What this means is all the transactions are conducted electronically and not over an exchange. The counterparty are the banks spread across various financial institutions across almost every time zone. There's a gap when the US banks are offline and the Asia takes over, say 4 a.m. to 6 a.m. time, Singapore time. Liquidity is lowest at this hour and you should avoid trading. Since there is no centralized exchange, it is not transparent, so to speak, and orders are filled according to the price the banks provide. Forex is always conducted in pairs. It is the exchange rate between two currencies. For example, the euro dollar. You are speculating on the strength of the euro against US dollar. A view that the euro will strengthen or appreciate will result in the actual value of this rate to increase. Let's take the analogy of exchanging money at the money changer. Say the euro dollar rate is at 1.14. This means with 1 euro dollar, you can change it for 1.14 US dollars. If you go to the money changer with 10,000 US dollars and change it to euros at this rate, you will get 8,772 euros. Later on in the future, when the rate increases from 1.14 to 1.16, you decide to change it back to US dollars. Now, when you change the 8,772 euros back, you will get 10,175 US dollars. Hence, you make a profit in US dollars from this exchange, about 175 US dollars. But instead of going to the money changer, using forex contracts, you can avoid using physical money exchange and speculate on this exchange rate. So you can simply make an online trade to buy a contract size of 10,000 instead of the physical money. At the exchange rate of 1.14, subsequently, when the figure rises to 1.16, you can close the contract and make a profit when it rises. Hence, you buy at a lower rate and sell at a higher rate when it rises. Compared to the money changers, the spread of forex is very tight at a 1 pip spread. Compared to many money changers, is about 50 pips spread wide. Next, we look at the characteristics of forex. Firstly, it is a bidirectional market. In the earlier example, your view is that the euro will strengthen, so you buy the rate first. However, if you think the rate is going to drop, you can sell the rate first, then buy back later. This allows you to trade both directions of the market effectively. With daylight savings, you can trade forex 24 hours starting from Mondays 5 a.m. Singapore time to Saturday 5 a.m. There is no trading during the weekends as the banks are closed. Hence, you can trade on your mobile through the app or at night when you have time to monitor at home on your PC. There are various contract sizes available to adjust the risk exposure according to your requirements. In the earlier example, the 10K contract size is the mini contract size. A pip movement is 1 US dollars, and a big movement of 100 pips will be about 100 US dollars. If you think the size is too big, you can scale it down to the micro size of 1,000 contract size, which is 1/10 the size of 10,000. For 100 pips movement, that will only be 10 US dollars movement only. So this is a very comfortable size for every new trader, and new traders can start with a smaller size to familiarize with the platform and trading. Subsequently, you can decide to pick a reasonable size That can be multiples of the micro, the mini size, or even the regular 100,000 size. Therefore, can be 4,000 or 17,000 or 113,000, etc. All the margins is in US dollars. MT5 is a US dollar-based platform. Margin required is 5% of the contract value. For a 10,000 euro dollar contract, that would be 500 euros, which is currently about 590 US dollars required. Of course, you can come in with US dollars or Sing dollars, but if you come in Sing dollars, it will be converted to US dollars. So with 590 US dollars in the account, you can get started with 10,000 mini size contract. If you want to do a micro size, that will be only 60 US dollars. This is a leverage of 20 times, as the margin required is 5% of the contract value. So you don't actually come up with the full value of 10,000 or 1,000, but only of 5% of this value, which is a leverage of 20 times. Due to the leverage, if the market goes against you, you need to do a top up to the account to meet a margin call. Else, if the margin drops to a low enough level at 20%, your positions will be liquidated by the system to avoid over losses. We'll explain in detail in the next slide later on. Next, there is no expiry date. This means you can hold a position as long as you wish, as long as you pay the swaps required for every day, or the interest. Basically, when you hold the positions overnight, past 5 AM Singapore time, you will need to pay swaps for it. You can avoid this by doing intraday trades only and close out the position before you go to bed. So these are the characteristics of the Forex contracts. Here are some of the major pairs that are popular among Forex traders today. We have Euro dollar, the pound dollar, which are the European pairs. These pairs are considered moderately volatile. If you like a pair which is less volatile, means less movement in the prices, you can trade Aussie dollar or dollar yen. So for dollar Swiss, it's a very volatile pair, and other crosses. If you are trading European pairs, you need to follow the economic data and political events that are happening in Europe and UK, such as the recent worsening Delta COVID situation in Europe. As the pairs are all versus the US dollars, monetary policies in the US will affect the currency, such as tightening of asset purchases by Federal Reserve. We'll talk a little bit about it later on. Now we'll do a quick explanation on the calculations of the Forex trades. Over here is an example of the Aussie dollar pair taken from the MT5. As you can see, Aussie dollar is trading here at 0.7348 versus 7349. The contract size, for example, is taken to be 10,000 Aussie contract size. You do not have to come up with the full value. So with 20 times leverage, you need to come with 367 US dollars for a mini size contract. The smallest movement in this pair here is 0.0001, 3 zeros and 1 1. That's the smallest movement. We call it 1 pip. Is equals to 1 US dollar. So let's say if you buy at Aussie dollar at 0.7348, right? And then subsequently the rate rises to 7358. As you see here is an increase of 0.0010, which is equals to 10 pips. As shown here, 1 pip is equals to 1 US dollars based on this contract size. 10 pips will mean 10 times 1, so 10 US dollars. It's quite a simple mathematical calculation here. So in the bank account right now, you have 367 plus 10 equals to 377 US dollars. So this is a typical example where you make a profitable trade. Let's take a look at another pair where this time, instead of making a profit, the market goes against you, right? So for this contract, euro dollar, we're also doing the mini contract size. Of course, there's a smaller contract size than micro, but the example here is a mini size, and the initial margin, also 5% of the margin required, is 590 US dollars. The smallest tick or pip is also 3 zeros and 1 1, 0.0001 equals to 1 US dollar. So right now, instead of $590, we have $600 in the account. Also more than enough to open one contract. So in this example, we also buy the euro dollar, and this time we buy at 1.1809. Right. However, for this scenario, we did not close contract because the market goes against you, and it has dropped to 1.1709. You can see here, doing a quick subtraction, there's a drop of 100 pips. So since 1 pip is equals to $1, 100 pips means you are sitting on the unrealized loss of $100 US. So what happens to your account? Well, if you're starting $600 in account, minus the unrealized loss of $100, you have a balance of $500 US remaining in the account that is still fluctuating according to the market price. So as you know that the margin for one lot is $590 US, which has to be maintained at all times, right? So the margin has actually fallen below that because the balance account is 500. So you have a 592 minus 500, a shortage of $92 US that requires a top up. So when this happens, you will receive an email from us generated by the system to do a top up of $92 US to bring the account back to 100% margin, which is $590 US. Of course, you can choose not to do so. So what happens after that? Next, we'll take a look at the auto liquidation by the system, right? Using the same example, since the margin requires $590 US and an account funds after the drop has dropped to $500 US, right? What happens is the system will auto cut the position if the margin drops to a low enough level, which is 20% of the initial margin. This applies to all the Forex pairs margins as well. So the margin requirement is $590, 20% of that is $120 US. This means that if your funds in the account drops from $500 and further drops further down to $120 US left in the account, the position will be auto liquidated and you'll be left with $120 left in the account with no open positions. So in summary, this is an auto cut system which will actually auto liquidate all your positions once it drops to 20%. So between now and the 20% movement, you can choose not to top up, and this may be a few days or a few weeks. If the market doesn't go against you until it reaches 20%, you can still maintain the position. But once it reaches 20%, positions will be liquidated. Please take note that the funds top up will also take some time to reach the account. Typically, you do use do a pay now, it'll take 45 minutes to be credited. And within this 45 minutes, any movement of the prices can actually affect whether the position will be auto liquidated. I hope you are following so far. So this is the quick explanation for new traders who want to find out more about Forex. If you have any questions, feel free to type them out in the question box and I'll answer them later on. So we have finished the first part of the webinar. We'll take a quick 20-second break before we move on to the next part, the fundamentals development on the Fed policies. All right, next we have the forecast of the FOMC interest rate decision. The Fed's new dot plot showed that 7 FOMC members see one Fed rate hike by the end of 2022. So this is actually a graph where they plot out the members' decisions on their votes on the interest rate and the timeline in the future. So on the left is the one that happens in March 2021. On the right is what is on the recent Wednesday statement. So as you can see, 13 of 18 members see a rate hike by the end of 2023, which is up from 7 in March. In other words, more members are seeing a rate hike coming in soon. Every quarter, members of the committee forecast where the interest rates will go in the short, medium, and long term. These projections are represented visually in the charts below, called the dot plot. The Federal Reserve now sees at least 2 interest rate hikes in 2023, according to the central bank's so-called dot plot or the projections. Currently, the central bank held its interest rate unchanged at 0 to 0.25%, where it has been like that since March 2020, and pledged to continue asset purchases at a rate of $120 billion monthly until substantial further progress has been made on the employment and inflation. So basically, they are focusing on two economic data, the employment data as well as inflation data, before they make a move on the tightening policies, where we see a reverse in the general fundamentals. Next, the Fed forecast on the economy based on the expectations. So they have slightly downed up these economic expectations for 2021 according to its summary of economic projections. Shown here is a chart of all the economic indicators projections. Central bank now expects real gross domestic product GDP to grow 7% in 2021, compared with 6.5% previously from its March meeting. Federal Reserve also upped its 2023 real GDP forecast to 2.5% from 2.2% expected previously. The Federal Reserve also sharply increased its inflation forecast for this year. It now sees the inflation running to 3.4% this year, above its previous estimate of 2.4%. The central bank also slightly hiked its PCE inflation estimates for 2022 and 2023. Core PCE inflation is expected to come in at 3% in 2021, up from March forecast of 2.2%. Core PCE for 2022 is now expected at 2.1% and is projected to stay at that level in 2023. The Federal Reserve still estimates the unemployment rate will fall to 4.5% in 2021 and expect the rate to drop to 3.8% and 3.5% in 2022 and 2023 respectively. So overall, a good forecast of economic numbers going forward, but a very gradual recovery. Well, as we all know, before they can actually increase the benchmark policy rate or the interest rate, tapering is the first step in this process. Well, tapering is actually the winding down or the withdrawal of monetary stimulus program that has already been executed. In other words, it is the reduction of the rate at which the central bank accumulates new assets on its balance sheet under the policy of QE, quantitative easing, which means the printing of money. This has caused the US dollar to depreciate over the past 1 to 2 years. The similar pattern has been shown in the previous QE after the 2008 financial crisis. Well, this is becoming a common thing for the Fed to do so, because continuing to stimulate the economy with easy money once the recession is over can lead to out of control inflation. So Federal Reserve is very cautious about inflation growth. Monetary policy driven asset price bubbles and also an overheated economy. So what the Federal Reserve has done is they have been very open with investors regarding the future bank activities, which helps set the market tone. This is why central banks typically employ a gradual or slow taper rather than an abrupt halt all at once to lose monetary policies. The central bank can do so by reducing market uncertainty by outlining their approach to the tapering, specifying under what conditions that tapering will occur. In this regard, the Fed actually lays out the PCE inflation forecast, the unemployment numbers, and the GDP growth. The abrupt introduction of tapering can lead to recurrence of so-called taper tantrums, whereby financial markets react sharply in a quickly downward reaction, a drop in the financial markets like the stock market, as well as sharp rises in the government bond yields. This has been the story for the past few weeks previously. This creates a powerful incentive to monetary policymakers to continue the QE or to delay or reverse plans to unwind their balance sheets in order to avoid this causing a negative reaction in the market. Back in 2013, when they had the first massive QE program implemented by the US Federal Reserve in reaction to the 2008 financial crisis, tapering came in 2013 when the then Federal Chair Ben Bernanke commented that the Federal Reserve would lower the amount of assets purchased not the elimination of federal asset purchases. For example, in January 2014, the Fed announced its intention to reduce its monthly purchases from 75 billion to 65 billion in February of the same year. Tapering will start at 6 billion a month for treasuries and 4 billion for the MBS. At this pace, the balance sheets will be expected to fall below 3 trillion by 2020, but instead, facing a stiff and immediate market reaction of taper tantrums, the Federal Reserve maintained its balance sheet at about 4.5 trillion throughout early 2018, before beginning only a very gradual reduction in assets after 2018. By mid-2019, market reaction to the mild pullback in QE had resulted in inverted yield curve and caused increasing indications of impending recession. Once again, the Federal Reserve began accelerating bond purchases, which is the QE, with asset purchases exceeding 4 trillion in December 2019. And then we have the COVID after that, and explode to 7 trillion in the early 2020 last year, as fears of the coronavirus gripped the Fed. So you can see that the Federal Reserve has been doing QE most of the time, only for a short period in 2018, where there was a mild pullback. So let's take a look at the other economic numbers that the Federal Reserve is looking at, which is the inflation numbers. First up, look at the US inflation number, the US CPI. It rose 0.9% month on month in June compared to May. It's the largest 1 month increase since 2008 June. Core CPI surged at a similar rate of 0.9% month on month, also beating the expectation of only 0.5%. Compared to 12 months ago, the June CPI inflation rate was higher at 5.4% year on year, from 5% last year in May. This is the highest inflation rate since August 2008 as well, while core inflation soared to 4.5% year on year, the largest increase since September 1991. So this is a story of an inflation increase over here in the US. Similar in the UK, the inflation surprised to the upside in June, putting it on course to breach 3% by the end of this year. CPI jumped to 2.5% year on year, above May's reading of 2.1% year on year, and exceed the expectations of 2.2%. So the UK is also recently started seeing an increase in the inflation numbers. Australia's headline CPI came in at 0.8% quarter on quarter, higher than the estimate of 0.7% quarter on quarter, following the 0.6% reading in the first quarter. Canada, however, on the other side, is decelerating in its inflation numbers to 3.1% from 3.6% in May. This reading exceeds the Bank of Canada's, still exceeds the Canada's 1% to 3% control range for inflation. So this is where they prefer the range to be and not above. But the more muted price increase support the bank's argument that the run-up is actually only transitionary. Policymakers still expect inflation to creep at an average of 3.9% in the third quarter, a level not seen since the early 2000s. During the monetary policy meeting at the European Central Bank (ECB) on July 23rd, it turns into the key focus point of the week following the release of its strategic review, where the Governing Council agreed a symmetric inflation target of 2% over the medium term. As expected, the ECB revised its forward guidance on the rates, taking a more dovish stance, meaning that it will continue to maintain low interest rates. The Bank of Japan, as widely expected, decided to keep its policy measures unchanged at its monetary policy meeting in July. And in July 2021 outlook, the economic activity and prices, BOJ kept its cautious recovery outlook, but downgraded the 2021 growth forecast. The view is well below 2% for its inflation forecast remains intact. So in other words, in summary, the US, UK, Australia are all seeing inflation number increases, and they all have pledged that this is actually a transitionary phase and a short-term reaction, after which when employment returns to the market, things will get, economic recovery will pick up, economic numbers will pick up, and this will be actually a positive reverse of the inflation rate that we see. And after all the inflation is over, they will start to increase the interest rate. So this is the fundamentals I have covered so far for the inflation and economic outlook. It seems to be in the pipeline on a gradual recovery, but it will be still a good couple of months, maybe at the end of the year, before we see any proper decisions on the interest rates or the tightening of the loose monetary policy. Next, we'll now proceed to do a technical analysis of the various Forex pairs. We'll start off with the euro-dollar. People will ask what time frame charts I usually use. I typically like to start off with daily charts to make an assessment of the general direction of the market. After that, I'll go into the 1 hourly chart to get the appropriate entry and exit prices. But today's analysis will be an overall view, so we'll be using the daily chart instead. Here we have the euro-dollar daily chart for the past 10 months or so. These support resistance lines are drawn around 2018 back then, so they still fit very well to the movements seen here. If you are interested to know how to draw them, feel free to sign up for the one-to-one coaching or drop me a message for the past YouTube video on how to do it. The euro-dollar pair is trading in a big boundary today at 1.1795 to 1.2237. It has tried to break lower, but has been able to stay in this boundary for now. So you can see the big movement over here to here. Recent movements show that it has finished a movement downtrend from the top of the boundary to the bottom. And it's now showing some bottoming out chart patterns over here. This is indicated by the 100% retracement of the recent drop over here. That means the fall from here and has been covered all the way up already. Showing buyers are putting a good fight back on the support level of the lower boundary. Hence, this is actually a support level over here. Yep, over here. Important to note that it has closed above the resistance level above about 1.1874, which is top of here. And prices have crossed 20 MA as well. Hence, the short-term bias will be to the upside. The first target level will be 1.1942, after which some profit taking and sellers come in for a pushback. If buyers with this engagement win this engagement, the next target level will be 1.2082. Notice this is the free fall zone 1.1942 to 1.2082. The area over here is a free fall zone. As shown historically, prices breached through this region without much support resistance in between. Also shown here the free fall. There's a similar pattern here. As this is the psychological big level, the 1.200 level, the 1.2 level. Directions are decisive in this region, meaning to say once they take a direction, they will more often not continue with it with no much volatility of both directions movement. So MACD is approaching the zero crossover line, which will likely to coincide with the entry of this free fall zone. As you can see, MACD is about to cross over the zero line. So when that happens, I think most probably we'll be entering this zone as well, which is giving a good impetus, technically speaking, for it to move, to push towards the next level. So if testing of the 1.1942 fails, the sellers will push downwards or 1.1795 again to retest this strong support level. So this is a technical view on the euro dollar chart. Next, we have the pound dollar. The pound dollar daily chart as well. It has been on a strong uptrend since the Brexit in February 2020. Recent movements show that it's taking a breather and entering a consolidation phase as seen from the sideways movements in the upper region. So it has been movement uptrend and then going to consolidation phase, a major sideways, so a consolidation movement. It's trading in the range of a consolidation of 1.3700 to 1.4206, well supported at 1.3700. as the V-shape rebounds recently is indicative of more upside momentum ahead, meaning this bounce back over here, a very strong V-shape bounce from this support level. And if it is retesting 1.3997, and if it succeeds, the recent resistance 1.4206 will be the target at the top, right? How it plays out depends on the BOE's decision on the tapering, the balance sheet, as well as interest rates. So the BOE policy decision is scheduled today actually to release 12 p.m. London time. We expect policymakers to vote unanimously in favor of keeping rates at 0.1%. There's likely to be a split vote on bond purchases, with Michael Saunders, which is one of the two members of the MPC committee, backing an immediate end to the central bank's bond buying program, which is a tightening of policies. The remaining of the committee should vote to maintain the target with the aim of completing the program by year end. We see that UK will be one of the first banks to start this process, probably even ahead of Federal Reserve. The central bank's GDP forecasts are likely to maintain its inflation estimates, peaking between 3% and 3.5% in fourth quarter. But policymakers view this to be transitionary, and is still likely to show a return to 2% target for the inflation target, maintaining the view that it will endorse its current pricing in its financial markets, expecting 50 basis points of rate hikes over the next 3 years, with the first 15 basis points of interest rate hike priced in by the third quarter of next year. Meanwhile, so this is actually the technical view, but I added a bit of the fundamentals. So we would see the pound dollar to remain strong in view of this movement fundamentally. Aussie dollar is next. It is technically on a correction phase, as you can see, the medium downtrend is down. As we see, the prices are channeling downwards. Upside is restricted by the resistance trend line, as shown by the resistance channel drawn here. The top side is the resistance trend line. In order for the prices to take further upwards, prices have to close above this trend line to give the first hint of possibility of upside. Well, it has actually done so. This chart was taken last week, so it will retest the level of 0.7476 if that's so. That's the pathway to that level. But if it fails to do so, that means it goes back to the channel. It goes downside. It's expected to test a lower supporting trend. The main range now is 0.7226 to 0.7605. That's the main range. Moreover, prices have dipped below the 200 MA, and we are still below the 200 MA. And the correction could take the fall to 0.7226. Meanwhile, 0.7330 serves as a recent main support, so I don't expect the 7330 to break easily, as we see some buyers trying to do a recovery rally. As Australia economic data is on a slow recovery, following the RBA meeting in July, the conditions for the rate hikes are unlikely to be met until at least late 2023. Meanwhile, we expect its QE program to be extended again in November, with a further reduction in the pace of the purchases announced. However, as prolonged lockdowns triggered by the Delta virus variant look to send the national economy back into reverse, tapering can be delayed. The cash rate is now at 10 basis points, 0.1% in Australia currently. So outlook for Australia is not that good at the moment, with a reverse of their movement in the reduction of the asset purchases recently. So more has to be observed before the decision can be made on Aussie dollar. Dollar candy is next up. It has already bottomed up in recent movements, as you can see here. The bottoming up and the Baker U-shape cup and handle movement here. It's on the initial phase of uptrend. So this is very, technically speaking, a very good sign. 100% retracement from the sell-off from 1.2600 is done, and currently is on a retracement downwards, which is a buying opportunity. Support levels are 1.2443 and 1.2317. The 200 MA is tested, and if it is breached, it means it's crosses over, the prices crosses over. You can see prices will take further upside to 1.2905. Recent dip in the prices below the 20 MA may set up this buying opportunity. So if your view is still uptrend and the uptrend will continue, well, this of course will depend greatly on the US federal policies. So if the US starts to increase interest rates or loosen the monetary policies, we can see an increase of the dollar strength coming up in the long term ahead. The main boundary, as shown here, is 1.2443 to 1.2905. Now this is for the dollar candy. We'll move on next to dollar yen. Well, dollar yen is very stable currently at a main range of 108.53 to 111.51. This pair should be quite stable for now, depending on the strength of the USD as well. In the future, if the dollars continues to strengthen, the pair is likely to test 111.51 again. So currently on a retracement phase with strong support at 108.53, which may pose to be a good buying opportunity. That's if all is all well that the economy is recovering and US will be expecting economic recovery. Right, so these are the technical views on the various pairs. We will now do a quick demonstration on the MT5. Some of you may have already tried a demo. If you have not, feel free to sign up for the demo account at the end of the webinar. It is free and the prices are live as shown, same as the live account. Right, there's also a promotion right now, so you might just stay tuned for a while more for the details of the promotional company. So over here on the left side, this is desktop version. You also have the mobile version. We have the prices of the different contracts. We have the Forex pairs as well as shares, as well as cryptocurrency. So you can click on view and then symbols. They are actually categorized in these different categories. So today's topic on Forex, you can open up this over here on Classic. By double clicking on the pair, you can actually add in the pair that you want to trade. It will be shown on the watch list. So one double click, you'll see a yellow color and means that it has been selected. Right, so you can also see CFDs as well as shares over here and also cryptocurrency as well. So just a quick demonstration on how you place a trade here. So for Aussie dollar, currently trading at 7411 and still rising in a short 1 hour movement. So, but it's still on the upside. So we just do a quick exchange execution, which is the market order. The volume contract size, you can set it for regular size is 1.00, which is 100,000. You can trade mini size, which is 10K contract size, as shown here, is 0.1. For beginners, if you really want to trade really small, you can go to micro size 0.01, which is just to test out the trade. So you can click on buy or sell depending on direction view. For here, we will use sell. So you can see that we sell the price at market and it's done already. We are in the order in position for 0.01 micro size at 0.74119, 0.7411. So currently due to the spread, there's a small loss of 0.09. So this is actually the profit and loss. Once this turns a blue figure positive number, you can close out a trade. There's no commission involved, and what you see here is what you get for the difference in prices. So you can actually do very quick in and out trades and close the position before you go to bed if you want to avoid paying the interest rate, which is shown under the column swap over here. And you have to pay swaps once you bring the position overnight. In order to, if you still wish to do so, you can actually protect your position by actually indicating the stop loss and the target profit currently is empty. So you can just double click over here. Double click over on this right here. Right, it brings up the trade menu again. The exact position here is by ID. So you can specify which position you want to close. In this case, there's only one position, so all the ID is here. To sell, the position is been sold at 7411. So I can actually set a stop loss. So if the prices goes higher, it will be against me. So because I'm selling right now, and I'll take a loss. So maybe just for example, I'll put a stop loss at 0.7450, just for example. So this is in terms of pips. So you can actually change it later on the trade menu. But let's say you put a 20 pips stop loss over here, and the top take profit. Maybe you take a 10 pips profit. You can also set it. Sorry, okay, let's do this again. So you can actually do the stop loss over here, 0.74. You need to double click on the stop loss and target profit boxes in order to bring up this trade menu. So 0.7450 is the stop loss, and the profit, let's say it drops to 0.7400, right? 0.7400. Oh, sorry, over here. 7400 for profit, right? So 7450. Okay, all done. So stop loss at 7450, take profit at 7400 if the prices come down. I'll take a profit. And then this is about the button over here, the modify this order. Click on this one, and you're set. You can see that the values that I input just now is shown over here, 7450 and 7400. And of course, at any point of time, if you want to close the position once in profit, you can do so. But before we do that, you can see this micro size only requires a margin of 37.06 US dollars, which is a very small amount of money. For new traders, this is a good way to start with micro sizes, and the amount of risk exposure is indeed very, very low. As you can see, the movement is like a few dollars movement at most if there's 10 pips movement. So the margin level, you can see there's a percentage over here, currently at 2,000%, which is well above 100%. When this number reaches below 100% and reaches 20%, the position will be auto cut. But we are have more enough funds to do so because we are having a very small position size over here. So this is the way you manage your position size and maintain a healthy margin over here, well above 100%. I would say at least 150%, if not more. To ensure that you have sufficient margin for top up if there's any main movements in the market. So over here, if you want to close out position when it's positive, right, for profit of 7 cents, right, a small position, you can do so by double clicking on it. Yeah, over here. Now take note, you have to close using the yellow button. Do not click on the buy button because doing that will initiate a new trade instead. So profit is 10 cents right now. I'll just take it. Right, so it's done. And then the amount of profit you make will be credited immediately into the account. So you can do this simple on the demo account if you wish to try it. Just sign up at the end of the webinar. Okay, so we have almost come to the end of the webinar. I hope you found the information useful. Let me just touch on the available services offered by Phillip Capital. If you sign up for the account, which is available online using my QR code that will be shown later, I'll be providing the WhatsApp economic data updates every week on Monday. This will be a technical discussions on the trades, and I'll be assisting you with any questions pertaining to your account or trading. I cover markets on Forex, global indices, precious metals, energy, and soft commodities as well. You'll be executing the trades yourself, but you have a second perspective on the technical aspects of the trades, and discussions will be made by WhatsApp. On top of that, we have the Trading Central Research Portal. Our in-house analysts will also assist you on the technical reports, which will be sent via email to you on the suggested levels for your reference. This will be on the suggested entry and exit levels for each of the trade for your consideration. It will be sent via the email as mentioned, showing you the directional view from the global research desk of the Trading Central. This can be a starting point for you if you are new on the technical aspect. Instead of doing your own research to identify opportunities that can make sense for you. Pairs include the gold, spot gold contract, the euro dollar, the pound dollar, dollar yen, Aussie dollar, dollar candy, dollar sing, and so forth. All the pairs I mentioned today. So this is an added service once you open an account, which is free to open. For fundamentals, we have the daily commentaries. The recovery on the commentary report also sent to you via the emails on the updates on economic news happening around the world. This will keep you updated on the latest economic news that may have potential impact on the markets, saving you the work of searching for it on the internet yourself. Hence, we provide the fundamental, also the technical aspect of trading information to you, and you can have a platform ready to enter the market whenever you are. So besides these analyst reports, you can also reach out to me on technical views on each of your trades as well. Next, we will cover on the ongoing promotion for account opening right now. That's ongoing until the end of the September, 30th September. When you open an account now and place a trade as small as 1 micro lot size and close it later at any point of time you wish or immediately, and also provide the feedback on the trading experience via a feedback form that will be provided to you. And complete all this before the end of September, you will get a total of $110 US credited to your MT5 account. Please note that for this promotion, you need to deposit a minimum deposit of 500 Sing dollars, which can be withdrawn after that if you do not wish to trade further, but can also be used for trading later on. Once received, there's a conversion of the Sing dollars to US dollars in the MT5, so take note of the exchange rate exposure. So the account holder, the new account holder that's opening this account, will be paid this incentive subject to the fulfillment of each of the criteria as shown in the table, broken into 3 parts. So basically, you can see the first part to open and fund, the $500, you get $40 US dollars. To trade one size, any size at all, you have $50, and then to provide the feedback NN20 with a total of $110 US dollars. They'll be completed by the 30th of September. The promotion does not apply to all other existing ongoing promotions, that can be referral or anything. Feel free to take this opportunity to open an account first, even if you plan to trade later on in the future, as this is a very good chance to get a free 110 cash rebate, even if you do not do much trade, just a single micro trade will be required. So if you're interested in doing so, trading Forex on MT5 is commission free, absolutely free, and intraday trades do not incur swaps. If you're interested to get started, this is a good time to get started. You can open a live trading account at no cost. To participate in the promotion, $500 is required. The entry level is low, so you can start trading with margins for each mini or micro lot with maybe $60 for micro lot or even 640 mini lot size. So if you've been thinking of opening an account, this is a good time to start with this promotion. You can get started with the account first and trade live when you're ready. When there's no admin fee or any costs involved in maintaining the account at all. So the process is very easy, can be done within minutes very quickly via your SingPass. Simply create an ID by scanning the QR code shown below here, or you can just access the URL by the side of it, and then the link will be tagged to me, and I'll be assisting you if you open an account using the QR code shown here. Alternatively, as mentioned, you can use the URL beside the QR code. Foreigners can also open an account online via this QR code. If you have further inquiries, do not hesitate to contact me by dropping me a WhatsApp message or email. My contact information will be in the next slide. So thank you for your time. We have now come to the Q&A session. So let's see if we have any questions for the people who have been attending. Yeah. Let me take a look. Okay, let's take the first question is, how much funds do I need to open an account? So as mentioned, it's only 500 Sing dollars to deposit for the promotion. If you do not wish to participate in promotion, you can also open an account first with no deposit of any funds. So, but the account is ready, and whenever you want, you can start funding in to start trading. So, but to participate in the promotion, you'll be advisable to fund in the funds to be eligible for it. And then you can do a withdrawal and remain the funds as long as you wish. There'll be no admin cost to maintain the account. What is the smallest size that I can trade? So there's various sizes that you can trade over here. The micro size, the mini size, as well as 100,000 contract size. So depending on the funds that you have deposited, you can trade in any contract size that you wish. Yeah. So let's see. What is the difference between MT5 and Nova? Okay, so the webinar today has been on the MT5, and this is mainly trading on Forex and spot products like CFDs as well. So for the Nova, it is mainly based on futures contracts, meaning to say these are contracts traded on exchange. So the main difference is that spot and Forex is traded on the MT5 and futures contracts are trading on NOVA. And you can't trade futures contract on the MT5. Yeah. So I would suggest if you are more interested in the type of products you want to trade in, pick the correct platform accordingly. On both platforms offer the mobile trading, so no harm in trying the opening up the accounts for the on the NOVA as well if you are interested in futures. Yeah. So do we have any more other questions? Okay, I think that's it. So that's all the time we have for today. Feel free to drop me a message if you want, or email me over here if you have any further questions. If you want to sign up a demo account, you can do so also on the previous slide over here, or open a new account by using the QR code. Right. Thank you so much for being such a wonderful audience. The link to the recording will be provided in a follow-up email tomorrow. If you have any queries on the webinar or just want to get started, reply to our email and I'll get in touch with you. This is Phil Gunn signing off, and I wish you a good evening ahead. Thank you.